Oh, nice. Here we go.
Hello, everybody. It's Helmer with your weekly mortgage market update. And I am live again this week. The last couple of weeks, I've been pre-recording these for y'all. Being live this week, I am joined with a live guest. We have Carlos Scarpero here today. Carlos, thanks for joining us, man. Today is October 18th, 2023. Just for a quick reference, Carlos, do me a favor. Tell everybody a little bit about yourself.
Sure. My name is Carlos Scarpero. I'm a VA mortgage specialist. Been a part of the VA community for a couple of years now. I'm with Edge Home Finance out of Dayton, Ohio.
Awesome. You kind of let me go there at the end. You're Edge Home Finance. And do you like long walks on the beach? No, I'm just kidding. All right, so let's see. If you are here live, go ahead and say hello. If you got any questions, please feel free to post those. We do love questions. Gives us something to talk about. If you're here live, go ahead and say hello. If you are watching on the replay, I know many of you do watch on the replay. Do us a favor. Just go ahead and make a little hashtag replay in the comments. We do monitor the post, so go ahead and ask your questions or share any thoughts if you do have them with that stuff. So let's jump in. I like to keep these brief, and to do that, we're going to jump right in. We're going to talk about rates in the market, and probably not a fun conversation, Carlos, right?
Yeah, I mean,
nobody wants to hear what we have to say this week.
No, I mean, it kind of sucks, but
yeah, rates,
it is what it is. It's funny. People are like, "Oh, it's going to go to 10% or whatever." I'm like, "What's the difference at this point?"
I mean,
it's 8, 10, 12, whatever.
I figured 8% was totally unthinkable. I figured 7% would never happen. I mean, let's face it. 2 years ago, October of 2021, we thought that rates would hit 3.5, maybe 4 in 2022, and that's when we first started pushing up into the 6s in 2023 and the 7s, and now we're in the 8s. So yeah, let's go ahead and we'll kind of give everybody that. So let's talk a little bit about it. So rates did move lower last week. It was actually a good week for mortgage rates. We'd seen mortgage rates move up, I want to say 3 weeks in a row. And last week, things kind of took a little bit of a breath, and it looked like we had peaked. In fact, that's a word that I had used. I'm like, hey, it looks like rates have peaked. I kind of really felt like we were there. All these conditions that are pushing mortgage rates higher. We're going to go a little bit deeper today. We're going to keep it brief, but we're going to go deeper and give you guys some insight into why mortgage rates are moving higher. It's not just a bunch of bankers around a round table that are, laughing and pushing rates up. And it's not even the Fed, if you will. There's a lot of variables coming into play right now. So rates did move lower last week, but it's proven to be a very brief reprieve. We've since seen rates hit the highest level in decades. I mean, I got into the business in 2000, so a little over 23 years ago, or about 23 years ago. And I remember when I got my own mortgage in 98 was the last time that I remember rates that were quoted in the 8s. When I got in the business, we were not even in the 8s back in 2000. Carlos, what about you? Any idea when you think we've seen rates this high?
It's been a long time. Yeah. So I'm kind of weird because I was in the business in 97, then got out for 20 years and then got back in. And so between 2017 and now, we've not seen this high even close.
Yeah, nothing even close to this. And I think 2017, I bought my house. I got a rate of 4 1/8, and I paid a little bit of money to get that interest rate. So, and that's what most of us that follow these things, it's where we thought after COVID, that's where we thought things would settle in, maybe into the 5s, and that would be high. Oh my goodness, rates are so high, they're 5%. And we've since seen them go higher and higher. Right now, VA rates averaging in the low to mid 7s. If you have gotten a rate quote over the last week and you are getting a quote today that is 0.5% higher, they're not taking advantage of you. That may be a legitimate rate quote. I mean, Carlos, have you seen rates as high as 0.25%? I mean, 0.5% change, or what would you say the biggest difference between last week and this week? Do you think that's not reasonable but it's actually truthful?
Yeah, unfortunately, yes, it is truthful. But rates are going up.
And it moved very quickly, and we'll give you guys some insight into why in a minute. Conventional rates, if you're not using your VA mortgage for any reason, conventional rates are averaging the low to mid 8s, sometimes much higher than that, depending on credit score and down payment amount. Have you seen anything in the 9s yet?
Not yet.
I would have laughed and said we weren't going to see anything in the sevens just maybe 6 months ago. And then, so I don't take any of it for granted anymore as far as where we're at. So as far as where we think things are going to go from here, rates have been pushed higher. The cause is up for argument. And this is going to get a little jargony for those of you that may watch. And I want you to ask questions if you do have them. And I'll go kind of a little bit deeper on this. But basically, I want to just show you guys some fancy charts and kind of explain to you where mortgage rates come from. So what we're looking at here, these are what are called mortgage-backed securities, and they're a form of a bond. They're traded on the bond market, and they are not tied to a 10-year treasury, but they are going to move up and down like the 10-year treasury yield does. The 10-year treasury yield is kind of the granddaddy of bonds and rates. So when you see the 10-year treasury yield going up, and right now we're at 4.92, that's the highest we've seen since 2007. But even in 2007, mortgage rates were not this high. Mortgage rates were in the sixes, I think, in 2007, if I remember correctly, when I was back then. But we are seeing this 10-year treasury yield go higher. So if you're seeing this number go higher, and you can find this, anywhere online on CNBC, lots of other places for free. If you see this yield going higher, that's a good indicator that mortgage rates are going to be moving higher with it. Now, what happens is if we take a look here at this chart, it's got green candlesticks and red candlesticks. That's what we call each of these lines, each of these individual lines. I'm going to make these a little bit bigger. I'm going to look at the last 3 months. Now, without going too deep into this and putting everybody to sleep, we are following a particular mortgage-backed security, which is the one that most lenders are pricing on today. So what happens is, in order to replenish their funds, if lenders were to lend out money to buy homes, eventually they'd run out of money. So to replenish their funds, they take those mortgages, and the mortgages are pooled together, they're securitized, and they're sold in the bond market as a security. And basically they're invested in by mutual funds and insurance companies and private investors in other countries. China, Japan buy our treasuries and our mortgage-backed securities. And up until recently, up until last year, the Fed would buy mortgage-backed securities to manipulate markets. It's how they drove mortgage rates down into the twos to begin with during COVID. So we follow this. And what happens is the green candlesticks show improvement in the price of these bonds, which makes mortgage rates improve, or your pricing will improve. When we see these red candlesticks and we see things go down, that pushes mortgage rates up. So there's an inverse relationship between rates and the price of these bonds. Now, last Wednesday, these bonds were selling at $98.59. And what that means is that you could buy a $100 bond, but you're getting it at a discounted rate. And the reason there's a discount is because of how the market views it as an investment. And it's always moving. The price of that bond is always moving. Sometimes you'll pay a premium and sometimes you'll pay a discount, because it basically, markets are finding an equilibrium of how it compares to other investments. So last week, if I wanted to buy a $100 coupon, I would have paid $98.59. So I was still getting a bit of a deal, and I would have gotten a 6% interest rate return on that coupon for the life of the coupon. And for mortgage bonds, there's some intricacies that make that kind of move based on payoff speeds. And again, it gets more and more complex the more we talk about it. But keeping it simple, when we see this price go down, that means that your mortgage rates have gotten worse. So on last Wednesday, we were at $98.59. Today, we're at $96.70. So, I mean, we're down. This is basically almost 2%. Each percent we call 100 basis points. We're down almost 200 basis points. And what that equates to is that mortgage rates have jumped up 0.5% because of that. And that all has to do with the price of these bonds. And that these bonds are moving because of the 10-year treasury yield and the overall investment strategy of a lot of investors right now. And the fact that they think that, unfortunately, we are going into an environment where rates are going to stay higher, not just mortgage rates, but car loan rates, consumer rates, all borrowing costs are going to be higher. And because of that, they're demanding a higher rate of return on their money when they invest it. They want a higher yield. So instead of getting maybe $2.50 yield on your investment, you want a $5 yield. You want more money for tying up your money. And that's what investors are really looking for. Now, when we look at this, we basically, when I give you guys a forecast, we're trying to figure out why is this moving and which direction will it move next. And that's why I look at all these different articles, and I read a lot of Bloomberg and Reuters and the Wall Street Journal and the Financial Times and all the boring stuff there. And we'll watch things like what are called Fed futures, where we see how the market is investing in what they think the Fed is going to do with the Fed rates and all of these different little things that we're watching. Now, the reason I bring all this up this week is because normally I'm pretty good at taking a look at all of these conditions, and I can give you a forecast, and I can say this is what's likely to happen. However, as was pointed out by this gentleman, Mohammed El Arian, who wrote in the Financial Times, he wrote a whole article about how all of this stuff has really become unhinged. It's not really making sense. So normally, if we see that markets believe the Fed is going to raise interest rates or hold them longer, that would be bad for mortgage rates. But we haven't really seen that. We've seen these numbers have all kind of held steady. We haven't seen a big expectation that the Fed will raise rates in the next coming meeting. We have a meeting coming up in a couple of weeks. Right now, there's over a 90% market expectation that they're going to leave the interest rates the same. And again, they don't adjust the mortgage rates, but when they set their Fed funds rate, it trickles through the entire economy. So when we see this kind of expectation that things will remain the same, that we may see an increase in December, about a 40% expectation, but we haven't really seen this number go past 40%. And yet rates continue to go higher and higher and higher. So where I'm going with all this is that a lot of the indicators have been very confusing. And because of that, we're kind of just trying to go along for the ride and give you the best advice that we can. So with that in mind, rates look likely to creep higher. And just a day or two ago, I was pretty comfortable thinking they were going to move back down a little bit. And that, again, we're not going to see rates move lower. And I think that's something that everybody has to come to terms with. Right now, buying a home with these interest rates, it's a struggle. There's affordability issues. What's your payment going to be? But if you hold off, it could be worse. And we'll talk more about that. And I'm going to bring Carlos in to talk more about that in a minute. The next thing, though, is that rates, they're likely to find a peak at some point. And I thought we already had peaked, but it looks like we haven't. And it looks like that, we're going to see them move a little bit higher before they're willing to move lower. And there's nothing really going on over the next couple of weeks. We only have one big economic report. And it's another inflation report, but it's not likely to really cause any real improvement. So we're kind of in a struggle right now as to where things will be. Rates are not going to move significantly lower until we see bond yields move lower and until we see more signs that the market is in, kind of seeing the labor market soften up a little bit, seeing the economy slow down a little bit. So I think that must be Bill Stevens. I only see Facebook user. He says, "Hey gentlemen," but I see that little, the little nanu Spock. So I think that must be my man. That must be my man, Bill Stevens. So,
nice.
So all of this stuff, it's kind of a downer, Carlos. And with that said, a lot of people are throwing in the towel or just not willing to even consider buying a home now. And, what would you say to them? Why do you think that now is still a good time to buy a house?
Well, there's less competition. People forget that 2 years ago we're sitting there. I mean, even in Ohio, I'm in a not as crazy market. And even here in Ohio, we had 10, 12, 13 offers on a house, and it was nuts. And now you got a house sitting on the market for 2 or 3 months, and you actually have time to think about it. The problem with that 10 or 12 or 13 offer scenario is people end up going into houses that they're pressured to buy. I mean, it's a major, major life decision. And so they're trying to buy a house, and the realtor says, well, you got 30 minutes to make a decision because they're going to sell it this afternoon. And then now they have to figure out, okay, is the garage the right size? Do I really care about this window? Am I going to overlook all these, conditions in the house and all this stuff? And so they oftentimes 2 years ago, people were buying houses that they felt pressure to buy. And now, breathing room. When I bought my house in 2001, we sat about it, we considered it, we prayed over it, we brought my parents in, we had a week to think about it. And you don't have that, or you didn't have that 2 years ago. Now you do, which I think is a good thing. It gives people time to really think about, do I want and need this house?
Go ahead.
And so the other thing is that, when, and you can always refi, 2 years, a year or two from now, at some point you can refi, but I don't think people should refi because of an expectation. You should buy what you can afford, with the hopes that you can refi at some point. I think where loan officers screw this up is they're like, well, you're guaranteed to be able to refi. No worries. Buy the home, date the rate, or whatever it is. Marry the home, date the rate is the saying. And I think that's dangerous because we just don't know. You've been wrong. Barry's been wrong. Everybody's been wrong. So we just don't know when it's going to go down.
We thought we'd be neck deep in a recession by now, and that rates would have come back down into the
sixes, for sure,
not be in the eights. So it definitely is something. Now, what about for somebody that wants to buy now and maybe they can qualify for a home today, but maybe the payments are just a little uncomfortable? Do they have options if houses are sitting, if sellers are eager to maybe, to sell their home? What should they talk about with their mortgage professional?
Yeah, so there is a buy down. So you can either do a temporary buy down or a permanent buy down. Personally, I do like the temporary buy down. That's basically a seller paid buy down, and you do that as a concession. So for example, if the rate is 7.5, you get 5.5 the first year, 6.5 the second year, 7.5 the third year. So that's a great option. Unfortunately, people get really scared of it, and oftentimes they don't take that advantage of that. But I think it's a great option. Right. You can't do permanent buy downs, but the problem with that is you have to, when you refinance the house, you lose all that money, and so you need to keep the house long enough to make up for that. And with rates coming down the next couple of years, I typically try to steer people away from that option, just because it's just better just to pay a little bit more and save your money and then refi it 2 years down the road.
Right. So just to kind of
perspective. So.
I agree. So for people that don't know what we're talking about, just to clarify a little bit, when we say buy down, what that means is to bring the interest rate lower. And you can do that by bringing money to the table. So part of the way, if you prepay money up front, you can get a lower interest rate. And we call those discount points. And a point is 1% of the loan amount. You don't always have to pay it in a full point increment. You may pay a half a point, or, you may pay $789, but you're going to pay to bring that mortgage rate down. The problem is once that money is spent, it's gone. And that mortgage, if you refinance later to a lower rate and you paid to bring that down, well, that money has been spent already and you don't get anything back. So that's why you always want to find out, how long is it going to take me to get a break even on this? How long until I'm starting to make money on this? If I bring my payment down $70, $80, $100 a month, well, if it costs me $10,000 up front to bring it down $100 a month, it's going to take a long time to get that money back. So maybe if $1,000 up front to bring it down $100 a month, maybe that makes more sense. Well, mathematically, you'll get different options that you can discuss with a mortgage professional about getting a discount and bringing your rate down. However, when you have that conversation, we have what's called a temporary buy down. So can you tell them a little bit more about a temporary buy down and what that actually is?
Yeah, so it's a seller concession, and it's a really weird calculation. There's all these weird spreadsheets you have to get to do it, but what happens is there's money in the escrow account, and then that escrow account will pay towards that differential. So say it's $10,000 in that escrow account that's paid towards that interest for, say, 2 years. There would be a $10,000 concession on the offer, but that does, on VA, it does count towards your 4% cap. And if you're doing FHA conventional, you got your caps on that as well. So, sometimes you have to consider, well, do I want my title fees paid? Do I want my appraisal paid? Or do I want a buy down? Because sometimes there's not enough money to get both. So you have to, figure out your priorities. And so somebody that might not have enough cash to close, maybe it might be better to get the title fees paid as part of your cash to close to reduce that, where you're doing a true zero down loan instead of use that money towards the buy down. So each case is individual. It just depends, and that's where a true mortgage professional that's advising someone can say, okay, here are your options, because there's no one size fits all.
Right. And of course, you guys can ask questions in the VA community and know that you're getting clear responses with information to back them up without any incentive for selling to you or with any ulterior motive. So if you guys have questions on that, you can, of course, ask those questions in the VA community, and moderators like Carlos will answer those for you and can give you more insight into that. Is there anything, again, I like to keep these about 20 minutes. We're at that point now. Is there anything, when someone has concerns right now and they're, just scared, what would you leave them with? Why? I'll just leave it like it. What would you leave them with?
It's opportunity. Think about it from a logical perspective. Don't take the emotion out of it, because oftentimes, unfortunately, these YouTube guys are like just completely emotional, have no logic. Think about it. If you're concerned about rates, if you're concerned that the rates are too high, guess what? Everybody else right now buying a house is also concerned about that, which means they're competition. So you have less competition if you're trying to buy a house.
Right. And that can give you a current advantage, less competition, less bidding, right. People not going crazy over asking price. You may be able to ask for some of that seller concession, which we've talked about, is when the seller gives you a credit towards your closing costs, or maybe towards that buy down to bring the interest rate, down on a temporary basis. These are all things that you can look at, and they're not going to be around forever, so there are some certain things. And then we've talked about buying a home when rates are high, especially with a VA mortgage. What is the advantage if rates do go down in a couple of years?
Well, you get your Earl streamlined, just like it says right there. So it's a great program. I did a lot of those when rates were lower. I haven't done anything lately, but yeah, it's a great program. No, very little credit check. Oftentimes that ain't check income. It depends on which lender. Some lenders will at least check you every job. No appraisal, minimal title work, very low closing costs. So yeah, it's a great program.
Yeah, so a VA mortgage has that advantage as well. And it is very likely, again, nobody has a crystal ball. It is very likely that rates will drop again at some point. Everything is cyclical. We are expecting to see where the economy will slow down, and the Fed will go ahead and start to pull back on all of the rate hikes and basically putting on the brakes to fight inflation. Once inflation continues to drop the way it has been, gets into the realm of where they want it, around 2%, then we're likely to see the Fed start entertaining the idea of lowering rates, just to get the economy into keep it in a healthy spot, and that's when we'll see mortgage rates also tend to come down as well. So it's not guaranteed, but it is very possible, and I would say likely at some point, but not anytime soon. Don't wait for that for the next couple of months. May not even be in 2024. We thought it was going to be already by this time in 2023. We've been proven wrong, and it may take longer. So awesome. Well, thank you, Carlos. Appreciate having you this week.
And thank you for having me. Appreciate it.
Take care, everybody. We'll see you next week. Remember, you can join us each and every week. Let me see. Where's my little, there it is. You can join us each and every week as we do this. Same bat time, same bat channel, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And I'll see you all next week. Bye-bye.
See ya.